Thank you everyone for joining us, and thanks James and Will for putting this on today. I thought I'd just start by giving you a bit of an update on all the team to let you know how we're going. The team says to say hello. We certainly all miss catching up with you in person, and we look forward to the time when we're all able to share a contact in person and to say hello. The team's doing well. We're keeping in touch formally via Zoom 3 days a week. We have these meetings where we go through all the client activity and what we're doing for clients and where we're up to and what's happening in regards to any of the product reviews. We have Microsoft Teams, which we use for work chat. So we're able to converse with each other during the day as if you're at a desk asking a question. Probably the only difficulty is someone can't help me to unclog the printer, but I'll have to learn that myself. But we are keeping in contact along those lines. And as importantly, from a mental health perspective, we have a social chat group, Providence Social we call it, where we can update each other on what's happening at home and how everyone's going. So I'd just like to thank you and wish everyone well. Also, you might notice on that screen, there's a new member of the screen, second column down the bottom, which is William Chan. William's joined us, working very closely with Will in regards to investment research and model equity portfolio. And we're delighted that Will's joined us from a funds management background and is a great member in addition to the team. So all the team says to say hello. Thank you for joining us today, and I'll hand over to James to run the rest of the webinar.
Thanks very much, Grant, and thanks everyone for joining us. As Grant's mentioned, we've got Will Chen, who's also joined us on the webinar, and also Will Porter, who is Head of Investment Strategy and works very closely with Grant, formulating input into the investment committee process, asset allocation process, and so on. So we'll make a start. Thank you for joining us. This is general advice only, just for a disclaimer. Most of you would have received your Global Outlook and Strategy, our quarterly formal document where we like to articulate our thoughts and views and stance. And if for some reason that you didn't receive that, please let us know. We'd be more than happy to send you a copy, either hard copy or soft copy. So we titled the most recent quarterly report, which this session is really just an opportunity for us to flesh out a little bit more detail. And for those that are interested in asking questions, if I could ask you to use the Q&A button that's either at the top or the bottom of your screen, and you can table any questions and we'll aim to get through a number of those at the end of the session. But we titled the most recent quarterly update, Too Big and Too Indebted to Fail. And I guess the reasoning behind that is that now that we are hopefully through a large part of the worst, well, perhaps not if you're sitting in Sydney or Melbourne at the moment, but hopefully the worst parts of the COVID pandemic, we've got to look at what's on the other side. And one of the biggest issues really is the amount of debt that is a flow and effect, both at the corporate, but more particularly at the government and central bank level as a result of all the stimulus measures that were put in place. And so that remains this whale, if you like, of a problem that will continue for some time. And therefore, central banks need to manage the process going forward. So major themes: we are in the hands of the central banks and their narrative. Global growth, however, is rebounding very strongly. And we're actually seeing a bit of a move away from some of the strength we've seen in the last 6 months in the US to the European economies, picking up the slack. And we'll touch on that. Recent inflation spikes around the world, the narrative certainly by the central banks is that is expected to be transitory, and the market seems to be running with that mindset. We do expect to see an increase of volatility, and maybe as Northern Hemisphere residents come back from their holidays, and I'm sure everyone's seen pictures of friends and family enjoying the beach somewhere overseas, which we can't obviously do. So we do expect an increase in volatility in the coming months, and more importantly, perhaps with portfolios, particularly after a strong recovery in portfolio performance over the last 12 months. A key really is to remain diversified with a value bias. So central banks, really it is in the hands for them. And if we think about the task at hand for central banks, and just to touch on a couple of points, central bank assets, really the great unwind is one of the major challenges that we will see for central banks in the coming months and years. They've expanded their balance sheets immeasurably over the course of the last 12 to 18 months by putting in place massive stimulatory measures, which we're all aware of, lowering interest rates, putting in place quantitative easing, where they've essentially been buying predominantly government securities to help suppress bond prices, to keep the market calm, to keep the financial system operating, and also to ensure that there's not volatility within the interest rate environment, which would of course spook overall investors and the global financial system. So tapering is really going to be the main issue for banks from here. So how do they start to unwind some of this massive increase in the central bank balance sheets that we can see here? And that's why we titled this chart here, Tapering is the New Black. It is all about the delivering of the message and that gentle walking the market through the concept of unwinding some of this stimulus, and at some point in time trying to actually increase interest rates if and when economies continue to improve. And you may have noticed in the last week or so, the messaging that's come out of the central bank in the US, the Federal Reserve, is they can do these things separately, i.e. they can start to unwind some of the quantitative easing measures, and they can leave interest rates alone, and they can address interest rates at another day. So they're really trying to, I guess, step across broken glass and keep markets very much aware of their messaging and their signaling without sparking any sort of irrational behavior like a tantrum rather that we saw a few years ago when the central bank tried to unwind some stimuluses a number of years ago.
Yeah, and Jimmy, I think you're right in regards to that. Just some of the observations is that it's baby steps, which I'm sure you'll go through. And the central banks are trying to work out how to unwind this enormous stimulus that they've given. And I think it's interesting, not well documented, but they're already sort of doing that in different parts of the plumbing in the financial system. Just recently in what's called the reverse repay market, which is the overnight market where banks park excess capital. US banks in particular have got excess capital in the order of $4 trillion, which the central bank would hate to see that flow generally out to the economy, because then inflation wouldn't be transitory, it'd be a big problem. So the central banks have gone into that market and they've actually put in $1 trillion there to buy that capital or borrow that capital off banks for an overnight small return. And that's just making sure that that capital is managed somewhat. So the reserve, if you like, the Fed in the background, way before they're talking about raising interest rates, they are trying to address that excess capital that's in the system.
Yeah, thanks, Grant. So while we see the central banks just gently easing the market with regards to their messaging about the unwind, investment markets continue to remain very, very calm. And you could almost say there is this genuine lack of volatility in terms of adverse price reactions in the bond market or the equity market while this is occurring, which is a little bit unique. And maybe now that the Northern Hemisphere summer holidays are starting to unwind, that may change. But while that's been occurring, the path of least resistance, certainly for equity markets, is to continue to grind higher. And it's really just interesting to note the US share markets now enjoyed 7 straight months of advances, which is quite unique in terms of not seeing a pullback in share market performances in the US over quite a prolonged period of time. And all the while, there's just been this continued surge of investment into not only the US equity markets, but broader equity markets. So the central banks are treading carefully to make sure their messaging is clear and they don't spook share markets. They're very much focused on the rollout of the vaccination, and we're seeing our own pace of that in Australia at the moment. And one of the benefits, if you can call it that, of the continued lockdowns in Sydney and in Melbourne is people are now actively getting vaccinated. We have a supply, and you can see there on the right-hand side, as of the 30th of August, at least one dose in Australia has hit 58%, and 35% of the adult population is 35% vaccinated. So the vaccination race around the world is a really important part of the central bank's forward thinking and also the narrative in terms of the reopening of economies. The other thing that's really important for central banks at the moment, and we've all heard the phrase, this time it's different, and one thing to bear in mind which makes this very truncated economic slowdown and commensurate recovery quite unique is the amount of support that the householder has received across the globe in developed markets via government-induced furloughed support. And that makes things very different, because normally when we see a recession, we see a huge amount of layoff, people are unemployed, they haven't got the ability to spend money, they dip into savings. This time here, we can see a really remarkable spike in savings rates that's come through as a result of the government stimulus. And governments are really expecting and anticipating, if you like, that stimulus money and that saving will be spent. So that's another thing that they're looking for as economies open. We're also seeing that the headline inflation rates are really picking up at the moment, and a large proportion of that relates to the supply-demand bottlenecks. So just to put that into context, as economies have opened up and businesses are trying to rebuild inventory and so on, in June we saw the largest 12-month inflation increase since August 2008. We saw a similar print in July, and even the core inflation rate, which removes some of the more volatile items that are within the inflation data, was a fairly solid 4.3% year-on-year growth. And this is the important thing, because the central banks are essentially suggesting this will be transitory. That has been their really strong message. And the markets, in particular the bond market, by virtue of where yields are at the moment, is very much of the belief that the inflationary pressures will be transitory. All the while, producer prices remain elevated, so the costs for producers in terms of raw materials. But what's quite interesting is, as I mentioned earlier, we're seeing a little bit of a transition away from strong US data in the first half of this year to a slight slowing. So retail sales in July in the US were lower than expected. Amazon and PayPal indicated that their sales are a bit lower than expected. And we're seeing a little bit of a migration of that towards Europe, which sharing the load, which is probably a good thing. And more broadly, we are seeing and continuing to see bottlenecks in supply chains, which is impacting short-term inflation and producer prices. We've seen a Chinese port closure, the third largest port closure. One of the divisions of that port closed because of COVID scares earlier in the month. And interestingly, we've seen Japanese producer prices the highest since 2008. So this is really just showing us around the world, there are these pockets of pricing pressures pushing up the inflation numbers as the economy as the economy opens rather.
Jimmy, just on that, one of the things that we talked about in the formal investment committee a couple of months back, and we've got that meeting coming up next Tuesday, is that given these increases in prices, what does that mean for corporate earnings, especially since companies are on very high levels? And we can probably talk about that a bit more when we're covering equities. But the interesting thing is, and the feedback that we're getting from companies, and certainly had it through the reporting season, that given that the consumer has a very strong balance sheet, they're able to absorb higher costs for the goods. So companies have been quite successful in passing on those transitory higher input prices. So corporate earnings at this stage don't look like they're going to be impacted by the higher input prices.
Yeah, that's a good point. Thanks, Grant. What is also interesting, just to add to that sort of supply-demand bottlenecks and in pricing pressures, is we can see here a series of key commodities: lumber, wheat, copper, iron ore, crude oil, and even dram, for those that are interested in what everyone's doing in their pastimes while they're in lockdown. We've seen a fairly substantial price increase over the first half of this year, but we're now starting to see some of that unwind. So this plays into the central bank narrative that perhaps some of the short-term pricing pressures and therefore inflation will be transitory. So that is something that we'll continue to watch. What is also really quite interesting is we can see that there is a transition within the producer price index, so the cost inputs for producers, that's actually moving away from goods inflation into services inflation. And the reason why that becomes important is within the services sector, if we start to see more pressure within the services sector, it begs the question of whether or not we'll actually see wages growth starting to emerge. We've seen an element of it. The year-on-year wages growth print in the US, the most recent one, was around 4%. So there is a pulse. And that's really, really important because we are seeing messages about difficulty of companies filling roles. So it begs the question, do we see a rise of the low-income wage earner? And that is very important for this transitory message, because the man on the street who is the low-income wage earner, he tends to spend every cent or every dollar that he gets in his pocket. So if he's finally seeing some wages growth and he is seeing a higher wage experience, it's very likely that he'll spend that money. And that's something that we're watching very closely, because that would play against the central bank's narrative of inflation being transitory. While this is all happening, you might beg the question, well, why are bond markets so low, and why is there this sort of general suggestion that inflation will never rise? And I think two things to bear in mind. One is that inflation has been at or around 1.5% and change for the last 15 years or so. So we've got very used to a low inflation number. If we look at the current implied five-year inflation rate, so what does that mean? It means, what does inflation look like in 5 years' time for 5 years beyond that? And this is this chart here. It shows us that the expectations of inflation in 5 years are still not that different to what we've seen over the last decade or so. So that comes back to the point that the market is very much believing the narrative of the central banks that the inflation messaging or the inflation pressure will be short term, and we shouldn't be worried about it and focused on it. So the key there really is watching wages growth, as it's a major input into rising inflationary pressure. But as at today, the markets don't seem to be worried about it. If we flip back to Australia and just think about how inflation is tracking in Australia, this grey band here is the target band for the RBA in Australia. 2 to 3% is where they'd like inflation to be. And we can see here that it's tracking well below that rate. So the RBA's got a quandary in Australia as to how on earth do they actually get inflation up, because it's not doing it on its own. While we're seeing these protracted lockdowns in Sydney and in Victoria, and also as a flow-on from COVID, we've seen a collapse in non-residential construction activity in Australia. More recent business sentiment and consumer sentiment prints have been lower. You would expect that, and they'll probably remain lower. Interestingly, the most recent GDP data print for the June quarter, which came out earlier this week, was quite strong, and even better than expected, which may surprise some people, but it is backward looking. I dare say that the next quarter GDP data print will look quite different. So there is a quandary in Australia and with the RBA as to what they do, given the protracted lockdowns in New South Wales and Victoria, and that impact it has on on economic growth in Australia, and how the RBA tracks their own stimulus measures here in the form of quantitative easing, interest rates, and the like. The other thing I want to touch on more globally is China's social financing spend is now back to a level seen last in 2018. So it's been gradually falling away. Interestingly, in China, we saw the second quarter GDP growth number slow. We've seen services indicators suggesting a slowdown in output in recent months. And for those that have been watching quite closely, some of the regulatory behavior in China has taken a bit of a turn in the last month or so by virtue of some fairly draconian measures that the Chinese government has suggested they'll put in place, or have indeed put in places. And in the listed stocks outside of China that are Chinese companies listed outside of China, there was significant selling pressure as they put their focus really was on healthcare and education and putting pressure on some Chinese stocks. And there was around about a $126 billion of value raised in Chinese listed stocks outside of China earlier in August on the back of this. So we're just watching closely this change in regulatory behavior with what's going on in China. So if we take a step back and just think about that from a helicopter viewpoint, in the US, we're seeing mixed messages with regards to the data. All eyes remains on the Fed Reserve narrative regarding their tapering and when they start to unwind some of the stimulus measures and how well they can manage that messaging and how the market behaves on the back of that messaging. In Canada, just as an interesting observation, because it's a similar economy to Australia, their second quarter GDP was down 1.1%. In Europe, we're seeing pockets of improvements, maybe some favourable mindsets over there with the European summer. And the most recent headline inflation print in Europe was a strong 3%, a number that hasn't been seen for a very long period of time. So perhaps some of the European economies are picking up the slack. Japan continues to have leverage to the global pickup, and that's why we took a position in a small position in portfolios to the Japanese equities late last year, given that leverage. China appears to be slowing. We'll be watching closely to see whether the government increases some elements of stimulatory measures. Asia Pacific, it's very country specific. Australia, we're in lockdown until vaccination rates improve, so likely to put pressure on sentiment and GDP growth, arguably in the medium term. Geopolitics is ever present. We don't have to look too far outside of Australia across to the Middle East to see what's going on there, and it's awful. And vaccinations, they matter. Anyone that's looked at the data and the difference in hospitalisation rates between countries where there's a high vaccination rate and a low vaccination rate will realise that the vaccinations matter, and that's what the central banks are really focused on, and really, I guess, hoping that governments around the world will continue to push hard for vaccinations, and for us, particularly in Australia. So let's just have a little bit of a look at some of the asset classes, just to tie in our thinking with regards to those messages. So within equities, we don't have to look at too far to realise that after this grinding higher and this surge of money that's sort of chasing income and chasing a return, we can see that on pretty much any measure, and these light blue bars show us the 20-year range of the valuations for global equities, and the 20-year average is the blue bar here. And we can see where the current level is, which is where these yellow diamond bars are. So we can see pretty much across the globe, valuations in equity markets are fairly elevated. Japan is the exception, and that just gives us more confidence about our exposure that we have in Japan for a pickup in economic recovery around the globe. So why are investors happy to continue to be buying equities? It may have something to do with this, which is dividend growth estimates. And we don't really have to look particularly far to see how quickly and how aggressively the growth estimates for dividends has turned around post last year. And why is that important? People are chasing income and returns because they can't find it in perhaps some of the more traditional areas that they'd be looking for it. And it is interesting when we look at the Australian reporting season, which has just concluded. There was 102 beats, so better than expected results, 128 that were in line, and around about, that's not 963 misses. I think it might be a bit of a typo there. I'd suggest it's probably more like 63 misses. And what's also interesting perhaps is the total ratings upgrades, 45 upgrades versus 62 downgrades. But the downgrade number might be something to watch a bit closer going forward, but I think the message is people are chasing income. They're happy to dial up the risk and take more exposure to equities to chase income.
Just on that, the downgrades and upgrades there is a rating measure. But if you actually look at earnings for next year have come down a little bit from where the expectations were. And obviously that comes back to where we are in lockdowns and the like. And some of the big highlights were big capital returns for investors through buybacks or higher dividends or those sorts of things. But leading back to what Grant said, the fact that companies are paying out huge amounts of capital or capital returns to investors suggests that maybe there's not that many opportunities for reinvestment at this point. And very hard for a board to make a decision to have a really big capital deployment program given the uncertainty around COVID. So happy to talk about anything else in reporting season if we get some questions, but there are a few of the things that we picked up.
Yeah, thanks, Will. And that's something that we've been talking about internally quite a lot, not just around Australian equities, but more broadly, is what do things look like in 2 to 3 years' time? And I'm sure Grant will like to add to this discussion. And it's just as relevant in Australian equities, but it's very relevant across really all investments and all asset classes. But if we just think about Australian equities as one subset for the moment, anyone that wanted a new television or a new microwave or a new fridge or whatever it might be has gone and bought that. They've gone and bought the second car or the third car or whatever it might be. And so it really just makes us think, well, a lot of that that money arguably has been spent. So therefore, we need to think about how to position portfolios for how things might look in sort of 2 to 3 years' time. Do you want to add to that, Grant?
No, it's just I think it's just a point that we've been trying to focus on. There's so much sort of noise around at the moment on the the short term, or where we are at the minute, and whether inflation's going to do this or when the vaccine rates get up. But there's not a lot of discussion about what the world looks like post-COVID and post the vaccinations. And obviously COVID's here for a long time, but we have to manage to live with it. So then the question comes about, well, what do asset prices look like going forward without all the stimulus and with slightly higher interest rates and with the amount that has already been brought forward, particularly in housing. And so particularly when we're investing for clients in assets that might have longer duration, that could be liquid for a 2, 3, 4 years, we just want to sort of make sure that we've got enough flexibility in the portfolio to take advantage of things that may come up, because a lot of expenditure has been brought forward, certainly not international travel, but certainly plenty of other areas. So it's just something to keep in mind about what the world looks like post-COVID, I think, in regards to asset values. And one of the comments just in the equity markets, and I pick myself up on this all the time, we look at the index and we say the index is expensive and the market's done this, but we've got to realise that the market now is distorted very much by a very small number of stocks. And the dispersion within global indices now is very wide. So you've had a lot of large companies that actually have performed quite poorly over the last 12 months, but they get hidden by the index that's been supported by a small number of stocks. And that's why we think it's very, very important to be an active manager in this sort of current potential volatile times, because there'll be big dispersion between stock performances and fund manager performances.
Yeah, thanks, Grant. So while we're seeing that chase for income and the grind higher in equity markets and around the world, really, and I touched on the fact that the US share markets had 7 straight months of positive returns, which is quite unique for the US equity market. It tends to be pretty volatile as a rule. What is interesting is, it doesn't mean, and this is a phrase that Grant likes to refer to from time to time, you can't always have every cookie in the cookie jar. And just to reflect on that, let's just think about a bit of a change in behavior. And there's been quite a lot of FOMO in the market really for a number of years, and people chasing returns and really feeling that every investment is going to go up. And we don't have to look too far in terms of the likes of Bitcoin and so on, and how volatile that investment stream has been, if you can call it an investment. But just to put it into context, Australian IPO experience in FY21, there were more than 50% of the 106 IPOs, so initial public offerings, new listings on the Australian equity market, that are under their issue price. There were 18 technology-related, loose terminology perhaps, initial public offerings in the financial year 21. 11 of those were under the issue price. And while that's all going on, the quantum of deal flow, both in Australia and in the US, is really picking up. So maybe this is again a sign of FOMO, but also perhaps a sign of change in corporate confidence. So this chart at the below here shows you the number of M&A, merger and acquisition deals in the US, and we can see it's lifted quite substantially. And that's just something that we're going to watch, because it suggests that there's an elevated level of confidence in corporates, and perhaps they're picking the eyes out of the equity market in terms of where there's some companies that have been suppressed by virtue of their valuation, and there's some opportunities for M&A. And we also note there's been a surge of unused credit in the US by corporates. So again, something to watch. But it's also worth noting this chart at the top. This is in the US. So the share of IPOs in the US with negative earnings got to a fairly alarming 80%. So just because there's deal flow happening and there's corporate activity doesn't mean that it's all stuff that we want to be investing in. So we just got to pull ourselves back from time to time and remind ourselves about that. With regards to property, for us at the moment, it very much remains thematic. So most of you will be aware that we're attracted to regional accommodation. This is in Australia. We're also attracted to certain areas within agriculture and specialist accommodation. And this also comes back to the point that Grant made earlier, really about thinking 2 to 3 years out as well in terms of what investments we look for. And again, this is another area where we continue to see a huge array of deal flow coming through. And we were touching on this last week in one of our internal meetings, just about how many new shops have opened up, if you like, proffering all sorts of product, not only in property, but just more broadly, as those that have got a spirited level of entrepreneurialism are trying to attract some of the investor capital that's looking for a home out there.
Yeah, a couple of new areas that we're spending a bit of time on, Jimmy, as you know, is the build to rent model. There's a lot of capital coming from overseas into Australia into a new sector, being the build to rent model, which is a very big part of the US market. So we're trying to get our heads around that and having a look at the operators. I think we've looked at 4 so far, so we're keeping an eye out for that. And also community housing is another theme that seems to be coming on as people are downsizing out of larger homes into smaller homes and providing that sort of community housing. So there's a lot going on, but as you mentioned, we just want to make sure that we've got a sort of a staggered maturing profile in the unlisted illiquid market.
Yep. Thanks, Grant. With regards to fixed income, those that have been following our narrative for some time now will know that we've been quite adverse to investing in this space, really because spreads across the fixed income subsectors are so tight. So everything in the credit space is priced for perfection, and it's also priced for almost no corporate collapse. So there are pockets within credit where there may be some levels of attraction, but just more broadly, the credit market, so corporate debt, is priced so tightly that there's sort of nothing left in the cookie jar. So by the time you look at the returns that you're getting at the moment versus the risk that you're taking, it really is broadly an unattractive area. So we're continuing to remain, I guess, opposed to any significant exposure to credit.
Yeah, and the only thing I'd add there is on US high yield, and I think I mentioned this in our last investment committee. So US high yield spreads are really tight, but not only that, the covenants and the investor protections that are attached to those loans as an investor are the weakest that they've ever been. So not only are you getting less return, but you're actually dialing up your risk even further. It's more equity-like than it's ever been. So it's a little bit of a concern for us. So it's certainly a sector that we haven't had a look at for a while.
It's a good point, Will, and to add to that, there's just such a large proportion of the credit pool that is one notch above investment grade, and you only need a handful of companies in that pool of credit that is BBB, that's one notch above investment grade, to have problems, and it can really taint the whole corporate debt sector. So for us, it's essentially stay away. Alternatives, we continue to have alternative exposure in the portfolio, primarily through our exposure to gold, which we've had for a number of years there, which has a two-pronged approach. One is to provide a buffer around volatility in terms of a bit of a safe haven status. And also, if the inflation turns out to be less transitory than what the whole world thinks, gold will also play a part in terms of protecting portfolios as it's a good hedge against inflation. And we continue to have exposure to diversified private markets, which we're happy to have within that alternatives basket. So cash does remain elevated. We're conscious that cash is generating little return, but as Grant always says along the way, that you can't give me too much grief about cash because you don't know how I'm going to deploy it. So we will continue to be opportunistic when we see pricing that's more attractive than where it is at the moment. So don't feel that we're not shy about using it. Cash has a place in portfolios, particularly in an environment where everything is elevated. And as we said at the outset, we want to make sure that portfolios are very diversified at the moment. So in the interest of time, I'm just going to summarize all of that. So for us, opportunities, senior secured first mortgage loans, sort of specific, but loan by loan specific, regional hospitality assets we touched on, active managers over passive managers with a value bias. So what do we mean by that? Grant touched on the point before that the indexes may look expensive across the globe, but within the share market indexes, there are attractive investment opportunities at a company by company level. So an active fund manager is picking and choosing individual companies to get exposure to in their portfolios rather than just buying the broader index. We touched on Japanese equities for cyclical exposure, gold for the inflation hedge, some select mid-markets corporate lending. So as I said, there is certain pockets of credit that we're happy to look at. Some risks out there to be mindful of: a sharply rising government bond interest rate, which doesn't look like it's happening at the moment, but that's the risk that inflation presents itself for longer than we all think. The unwind of the fiscal and monetary stimulus package and how investors and markets behave to that. An unexpected inflation flare-up beyond what we're seeing. Defaults and insolvencies impacting the credit markets, which we just talked about. Another variant of the COVID that is immune to vaccinations. Well, God help us if that occurs. That's the last thing we need to see. Geopolitical tensions. Well, I've touched here on Taiwan, but they could be anywhere. They're always something we have to be mindful of. So putting that all together, what does that mean? So what? Stay the course, remain very diversified and disciplined within the portfolio, and particularly conscious of protecting the returns over the last 12 months. We do expect an increase in volatility and lower income generated for portfolios by virtue of a lot of the traditional income generating investments generating lower returns. So that's the summary. Before we go to Q&A, I like to have one slide, which is my golden star slide. I could have picked quite a few, but I'm just going to use this one just to put the world into context. So this is just how mad the world has become and how people are so fixated with everything online. So this is Elon Musk, who's got around 59 million followers on Twitter, for those who follow Twitter. In January this year, he typed 2 words: use Signal. There is a listed stock in the US called Signal Advance, which is a technology company that engages in the development of proprietary Signal Advance technology. So his 59 million followers, or a certain number of them, thought that that tweet meant buy that stock. So that stock, Signal Advance, was up 527% on January the 7th, and then up a further 91% on January the 8th, and closed at $7.19. After peaking intraday at $70.85, that's 70.85. It's currently at $1.09. So it just shows the things that are going on, and this is just one tiny little example, but the crazy things that are going on in the market at the moment, and how irrational behavior has become by virtue of one tweet. What Elon Musk was actually suggesting was that his followers use the Signal messaging platform, which has absolutely nothing to do with Signal Advance, a technology company. So just a slide on the madness that sits out there in the world. The other thing, just finally, before we go to Q&A, you would have all received via email this week, or maybe at the end of last week, the Providence activity report for the first 6 months of this calendar year. This is really a look under the hood of Providence, of all the transactions we look at, the fund manager research that we do, the transactions we accept, the transactions that we reject, and the rationale behind why we do that and why, and really a look at the research that goes on behind the scenes. So for all of you that are interested in what goes on under the hood, I encourage you to have a look at this report. If anyone didn't receive it for any reason, then please let anyone in the Providence team know, and we'd be delighted to either send you a hard copy or a soft copy. So
yeah, Jimmy, I think, like in regards to the markets and stuff, although we're, remaining diversified, the portfolio's had a, very strong, solid 12 months into 30th of June, which was pleasing for us to see for our clients. So, there is still opportunities out there. I think it's just being alert to, different opportunities than what you traditionally see. And as you see in that activity report, in the 6 months, there was a total of 74 presentations, meetings from funds, fund managers, products. So, that's sort of 3 a week that we're seeing in regards to that. We declined, over 25, accepted 8, and the other 38 presentations was just part of our DD. So, you know, there is quite a lot going on. I mean, Mike can't join us today because he's in a meeting on a private equity opportunity. Justine can't join us at the moment because she's having a presentation on sustainable fishing. So, you know, there is a lot of product out there, and there will be opportunities. We just got to think a little bit differently and make sure that we protect the portfolios if we get an inflation spike, or if we get a credit event. But in the meantime, value assets are still value assets, and we can get reasonable returns, which is what we're trying to do.
There is a question here from one of our more technically minded listeners. So I might throw it to one of our more technically minded panelists, being Will Porter. But the question is, or Grant for that matter, the question is, post getting to a higher vaccination rate in Australia, will the higher activity that leads to a higher revenue or profit environment be offset by a higher discount rate, so lower price earnings ratios in sector performance? And does that suggest to be an asset allocation neutral strategic weighting? So there's quite a bit in that. So I'm going to throw that over to you, Will.
I've actually done a bit of work on this, and I can see who sent the question through, and I'm happy to share it with you. But it depends how much you're expecting the revenue and profit to grow relative to how much you think the discount rate's going to move. And we've done some scenario analysis around that, and I can share some results. I don't have it off the top of my head, but you know, there's a lot of central bank intervention as well on where discount rates are. So you've got to assume that some of that's coming out. So there's a lot to it, and I've written some documents, and I'll send it through to whoever had asked that question.
That technically minded participant.
Yeah.
No, I think you know this is a really, really difficult time because, you know, the price signals that we normally rely on to try and work out valuations are distorted. So, you know, for the last 40 years, when being in markets, you know, there's certain things that you watch which give you a bit of a sign about what the future might look like. Well, at the moment, there is so much distortion within asset classes, it's very difficult to answer that question in regards to, you know, asset allocation. But I think it's safe to say that multiples at the moment are very much predicated on that low discount rate. And that may stay the same for a while, but if it doesn't, there would be a readjustment. And I personally believe, and we're spending a lot of time on this, I personally believe asset allocation will look a lot different in the next 10 years as it has in the past 20 or 30 years. And I think we've got to be, you know, attuned to that. Be careful not to become, you know, a dinosaur and be disrupted by, you know, some new thoughts. So I think it will change. I think what doesn't change is that if you can find assets that provide consistent cash flow and can ride through the cycle and has got a value bias, I think that will not only give you a reasonable return, but also protect your capital through a difficult time.
Yeah, thanks, Grant. So there's no more questions. So in the interest of time, we might call it a close. I just thought, Grant, it might be worth, before we close off, just mentioning the quarterly luncheon webinar that we've got happening at the end of or later in September, and our guests.
Yeah,
just to put you on notice.
Thank you. Just trying to remember what webinar.
Jonathan is his name.
I know. Look, we obviously the client lunches are on hold until we're all able to get together. So, but we still wanted to keep in touch, and as you know, we try and find something a bit interesting to talk about, to bring to our clients at the time. But what we thought this time is that we'd ask Jonathan Shapiro, who's a Walkley Award winner, journalist, writes for the AFR. We know Jonathan reasonably well because we compare notes on bad behaviour that's going on in the markets, and we try and help Jonathan when he's looking at those sort of things. But Jonathan's written a book on Afterpay, and he's written it from the start all the way through. And I thought it'd be great for him to share with us the insights of what made Afterpay such a successful business. and quite frankly, why the hell didn't we realise how good this stock was, and what should we be looking for? So we thought it might be good for Jonathan to come and share those insights. What does that mean for the technology sector in Australia? Where's the next afterpays? What should we be looking for? And I thought it'd be quite a fun and interesting a presentation. So if you can join us, we hope you would enjoy that.
Thanks very much, Grant. We might call it a close. So on behalf of Providence, thank you everyone who has joined us today. We have recorded this session, so please feel free to share it with family and friends if you think they might be interested in the walk through our current thinking and stance. And we look forward to seeing you all in person again as soon as we possibly can. Stay safe and thank you very much for joining us.